Hello, and welcome to Financial Accounting. Our topic today is contingent liabilities. We will look at the accounting treatment of contingent liabilities and how it depends on the likelihood of occurrence and its measurement. We will also look at several examples. Some liabilities might arise from past transactions if certain events occur in the future. These potential liabilities are called contingent liabilities. The accounting for contingent liabilities depends on two factors: the likelihood of the future event occurring and its measurement. The first step in evaluating contingent liabilities involves determining the likelihood of the future event occurring. The likelihood may be probable, reasonably possible, or remote. The next step is measurement. In case the likelihood is probable, the accounting treatment depends on whether the liability is estimable or not. If the likelihood is probable and the amount can be estimated, the liability must be recorded and disclosed. An example of this would be the liability for warranty repairs. In cases where a contingent liability is probable and its amount is not estimable, the accounting treatment is to disclose the liability in the notes to the financial statements. For example, a company may have accidentally polluted a local river by dumping waste products. At the end of the period, the cost of the cleanup and any fines may not be able to be estimated. A contingent liability may only reasonably be possible. In this case, the contingent liability is also disclosed in the notes to the financial statements. No disclosure is required in the notes to the financial statements when contingent liability is remote. Let's look at a couple of examples of a contingency that is probable and estimable. Delta Corporation owns a property on which chemicals had been stored in the past. The local zoning commission has notified Delta Corporation that it must remediate the property. Delta Corporation hired a consulting company to estimate the cost of remediation. The cost has been documented at $250 million. Delta Corporation must record the $250 million as a contingent loss and disclose the details in the notes to the financial statements because the amount of the loss has been reasonably estimated and it is probable that the loss will occur. What if the zoning commission had not indicated the liability? In this case, it may have been more appropriate for Delta Corporation to only mention the loss in the notes to the financial statements. In another example, Delta Corporation received a notification that a third party may begin legal proceedings against it based on a situation concerning environmental damage to a site previously owned by Delta Corporation. Based on the experience of other companies who were subjected to this type of litigation, it is probable that Delta Corporation will have to pay $80 million to settle the litigation. A separate aspect of the litigation is still open to considerable interpretation. It could potentially require an additional $120 million to settle. In this situation, Delta Corporation should accrue a loss of $80 million for the part of the situation for which the outcome is probable and for which the amount of the loss can be reasonably estimated. I hope you found this video helpful. If you did, please make sure to subscribe, hit that like button, and ring the notification bell so you are notified when we release more videos like this. Thank you all so much for watching, and I hope to see you all again in the next video.